The stock market has experienced some very large ups and downs over the course of the last couple of weeks. The Nasdaq, for example, officially entered the bear market last week. And so it comes as no surprise that a record number of tech and growth stocks have plunged by 50% or more. To name just a few very well-known examples here. Meta Platforms, the streaming giant Netflix, the Chinese technology company Alibaba, as well as the online payments platform PayPal. They all suffered declines of around 50% or even more, and Facebook and Alibaba alone lost a combined market value of more than 1.1 trillion US dollars. And as this chart here from Charlie Bilello shows, those stocks that have performed exceptionally well in 2020, all of the ones you can see on screen right now delivered triple-digit returns, while they have been particularly hard hit in the recent stock drawdown. And this brings us to today's video. Sure, we all love the spectacular returns that almost all stocks delivered in 2020. As I said, so-called growth and tech stocks in particular performed exceptionally well. We all felt like superstar investors in 2020, didn't we? But if you want to enjoy those marvelous investment returns over a longer period of time, well, there is a price that you have to pay. So what that price is, the price investors have to pay for market-beating returns. Well, this is what we will discuss in this video. And so without further ado, let's get started. Alright guys, my name is Ray Zellman and I would like to start today's video with an analogy. Everyone likes to be successful, right? Generally in life, in the corporate world, maybe when it comes to your hobbies, your social life, and so on and so forth. And of course, regardless of the field you want to be successful in, there is a price you will have to pay for your success. In fitness, for instance, if you want to be stronger, maybe more muscular, of course you will have to go to the gym more often, lift more weights, and possibly adjust your diet a little bit. Maybe you will have to cancel some social events in favor of your gym sessions. So that's the price you have to pay if you want to be stronger and more muscular. If you want to be more knowledgeable about American history, for example, you would want to allocate more time to reading books about history, obviously. Maybe you need to watch a ton of historical documentaries, go to museums, go to panel discussions. But again, regardless of whether you want to become the next Arnold Schwarzenegger or the next historical guru that is invited to TV shows, getting there requires patience and discipline, of course. You will not get there overnight. So both goals require you to pay a certain price. And that is why not very many people look like Arnold Schwarzenegger used to look like when he was younger, at least. And not very many people are particularly knowledgeable when it comes to American history. And investing is similar. Everyone would love to have or achieve Warren Buffett-like returns of 20% annually, but very few people actually do. Most individual investors actually underperform benchmark indices, and they actually do worse than average. And I think this is also mainly caused by the fact that most individual investors aren't willing to pay the price that is required to achieve Warren Buffett-like Hall of Fame returns. So let me just show you what the price of Warren Buffett-like returns is. And I will illustrate this with two examples, namely Meta Platforms and Netflix. As this chart here shows, Facebook has outperformed the S&P 500 index by quite a margin since mid-2012, generating returns of around 680% versus 230% of the S&P. And if we now add Netflix, well, you can see that Netflix performance has been even more staggering, as Netflix basically 38x investors' money over the last 10 years. And that's even after the stock was essentially cut in half over the course of the last couple of months. At its peak in November, Netflix stock had actually 70x investors' money over a period of just 10 years. Now, you obviously did not get those market-beating returns for free. As the saying goes, there is no free lunch in investing. The price you had to pay for those returns was volatility. Both the stocks of Meta Platforms and Netflix have been much more volatile than the S&P 500 index. If we start by looking at Netflix, for example, you will see that to get that 30 bagger, you had to endure 1 80% drawdown, 3 40% drawdowns, and a couple of 20% drawdowns. Now I want you to seriously ask yourself, how many investors do you think were actually able to hold Netflix through these massive stock declines? If I had to guess, I would guess that of those investors that were invested in Netflix back in 2012, so before the 80% drawdown, certainly less than 5% never touched their Netflix investment over that 10-year period. And the number might actually be much lower, likely below 1% and possibly below 0.1%. Now, similarly, Meta platforms also handily beat the market since 2012. We've just shown that. But Facebook investors also had to hold their shares through 2 50% drawdowns, 1 40% drawdown, and 1 30% price decline. And again, not being bothered by these periods of massive losses. To be clear, those are just paper losses if you don't sell. But again, not being emotional about these, let's call them temporary losses. Being patient, trusting your business analysis, and remaining disciplined is basically the cost of admission. Again, the price you had to pay in order to enjoy those marvelous long-term returns. Of course, you will likely not just hold one stock in your portfolio. But as I've outlined in another video on my YouTube channel, if you want to outperform the market, you more or less have to run a concentrated portfolio. However, running a concentrated portfolio of say 5 to 15 stocks comes with more volatility. And with more volatility, there will inevitably be periods of underperformance. Accepting that you will underperform the market over periods of 1, 2, or 3 years is something you will have to accept if you want to pick stocks yourself. And not losing confidence in your skill in these times of underperformance is incredibly hard and challenging, if you ask me. Very few people can do it. Now, I think there are 2 very important lessons to draw from these 2 examples, so please pay attention now. First, you want to buy high quality companies that you can have conviction in and hold for the long term without getting nervous during periods of significant underperformance. In fact, you should get excited about periods of underperformance if you ask me, as they allow you to accumulate a larger stake in those high quality businesses at depressed prices. And hence, sharp sell-offs because of short-term headwinds maybe or minor disappointments should not be treated as a warning signal, but rather a buying opportunity, as long as the business's long-term outlook hasn't changed fundamentally. Also, simply keep in mind that the intrinsic value of businesses usually doesn't fluctuate as heavily as their corresponding stock prices. And also keep in mind that the downward trends can sometimes be much more persistent than you would like. To quote Miller Partners here, the challenge, poor price trends can continue much longer than expected, and they correct only when trends reverse. Valuations provide no support. For truly long-term investors, this creates an amazing opportunity to build positions at attractive prices, but it pressures shorter-term performance. The second lesson to be aware of is that as an active investor, you need to be psychologically prepared for these periods of underperformance. Massive declines in valuation can be, as I said, psychologically challenging, especially if they result in your net worth declining significantly as well. I'm sure some of my viewers have felt the urge to maybe cut some of your losses during the most recent stock decline. Or maybe you have tried to time the market, or maybe you just felt the urge to try to time the market by selling a stock and hoping that you can buy it back later at a more attractive entry price. Personally, I think that's not a very sustainable investment strategy and process. So what helps in such volatile periods, I think, is reminding yourself of your ultimate long-term goal. And for most investors, that's compounding one's capital at above average rates. And to achieve that goal, you need to stick to your strategy that you have outlined during calmer times. And for most long-term investors, that includes doing very little when markets crash. You might add to some of your positions, but you most certainly don't want to sell and panic. Acknowledging that doing nothing can actually be a very active decision helps a lot, in my opinion. Acknowledge that activity in itself is often actually counterproductive, and doesn't lead to better investment returns. I would love to quote the excellent investors of Rowan Street Capital here. They wrote, "Since we are not constantly buying and selling, the lack of action in the portfolio may look like we are snoozing, but what we are doing is actively waiting and allowing our carefully chosen management teams to execute." Actively waiting means verifying that the three parts to our compounding machine are still intact: business, management, reinvestment opportunities. Now let me point out that the dynamics of stock markets might have fundamentally changed in the recent years, leading to sharper and more rapid sell-offs than we have seen in the past, as well as faster recoveries. And if you want to learn more about this phenomenon, the influence of social media platforms, and how you as an investor can best exploit these new bear markets, I highly recommend watching the following video.